Here we sit at the precipice of what we believe to be the next rate hike at the Fed's December meeting. We're looking to go to 2.25% on the Fed funds rate. Woo! But we know from what Jay Powell has told us that that is still 3 rate hikes shy of what he considers to be neutral, a neutral Fed funds rate where it's the Goldilocks level, where the economy is not overheating or slowing down. He considers to be 3%. Unfortunately, his predecessor, Janet Yellen, is on record as having implemented the slowest, most prolonged, most painstakingly painful tightening in U.S. history under her leadership. In other words, Janet left Jay with a lot of work to be done, with not so much time. Hello, I am Danielle DiMartino Booth. Happy to be back on Real Vision since the last time I was on. I have founded a new company called Quill Intelligence. We produce a daily newsletter called The Daily Feather, and it's already garnered a cult following, rolled out right after Memorial Day, and we're looking to truly launch a research revolution that is based on my many years inside the Federal Reserve when I did research on behalf of President Richard Fisher of the Dallas Fed that was unbiased and had absolutely no agenda and wasn't trying to sell anything. And believe it or not, investors really enjoy that. They appreciate that. So how did we get here? Well, it started on August the 11th, 1987. And unlike Jerome Powell, who had no days in office before he was greeted with a crashing stock market, Alan Greenspan had a few months as chairman of the Federal Reserve before he was greeted with the crash of 1987 when stocks fell 23% in one day, which hasn't been matched since then. We might find out in the coming years what it feels like. But in the days and the months that followed, Alan Greenspan did something extraordinary that set up where we are today and where we're headed. He actually leaked information to bond trading desks ahead of Fed moves to inject liquidity into the system. This was fully sanctioned, and he had the New York markets, open markets desk as his compadre to do this. And that was when, in the current era of monetary policy making, moral hazard was introduced into the system. So following 1987, every other hiccup in the markets, whether it was the tequila crisis in Mexico with the peso, whether it was the Orange County bankruptcy, a few years later we had long-term capital management blow up. Famously, obviously, Jimmy Cain refused to write the check to bail out that big academic-run hedge fund. But every single time there was a liquidity event in the markets, the Fed would come riding to the rescue. So fast forward, I'm going to bring Jay Powell back into this discussion. Fast forward to the fall of 2012. What did we learn on January the 5th, 2018? Well, we had the transcripts released. We actually got to hear Jay Powell in Jay Powell's words, because he's a very quiet man. We got to hear what Jay Powell thought about this era of unprecedented moral hazard and how it had woven its way into investors' psyches. And he basically said, I'm reluctant to vote for this final round of quantitative easing. It has become habit-forming to investors. And by all appearances, we are blowing a fixed income duration bubble across the credit spectrum. I just got goosebumps because look at where we are today. Look at where risk lies today. But the point is, every single time the Fed had to pull out extraordinary measures, it had to pull them out for longer than the prior episode. When the internet bubble crashed in 2000, we had to take interest rates even lower. We had to keep them even lower for a more protracted period of time. And that served to blow the housing bubble up. Obviously, there were many other players, credit rating agencies, investment banks, crooked mortgage brokers, delusional home buyers. But the Fed was right there, keeping money cheap, lower for longer. In the current episode, call it the past decade, We took one step beyond, one step further into the abyss of this grand experiment by keeping money lower for longer and engaging in quantitative easing. There's a name for it. It was designed in 2007. It's called the Bernanke doctrine. Bernanke took a few people into a quiet room in Jackson Hole, a few of his closest advisors, which is questionable on an ethical level itself, and they laid out the fact that the Fed would have to get to the zero bound first. That was a critical step one before it could then launch into quantitative easing. It was designed in private, and the game plan was laid out for what was to come. So what is quantitative easing, and how does the current era of lower for longer differ from its prior episodes? So we haven't, I still have pronoun challenges as a former Fed insider. How did the Fed conceive quantitative easing? They basically wanted to synthetically produce interest rates that were lower than what they could get them to on a numeric level, the zero bound, as we called it. So in order to do that, they decided to go out into the open market and purchase securities. In fact, inside the Fed, they never called it quantitative easing. They called it large-scale asset purchases, because that's what people inside the Fed do. They put big fancy labels on things so that people are confused and don't know what the hell they're doing. So these large-scale purchases were rolled out slowly, one wave after another. It started with the United States. It started with Ben Bernanke, but it was as contagious as the clap. I mean, it went global, it went viral, it went everywhere. And eventually, we had, obviously, the Bank of Japan, we had the Bank of England, we had the European Central Bank, we had the People's Bank of China, one of the biggest quantitative easing programs in existence was very quietly undertaken in China. So at the end of 2018, at the end of this year, which is very close to us, for the first time in a decade, we will go net negative. We will flip on a global basis to quantitative tightening. To explain how dramatic this is, consider the furor at the Federal Reserve letting Lehman Brothers fail and within the blink of an eye rescuing AIG, $85 billion bailout. By the end of 2017, global quantitative easing was running at a $2.12 trillion annual run rate. It was as if we were bailing out AIG every single month. And then some. And then started 2018. By October, the European Central Bank had tapered its purchase program, its QE program. It had tapered it down to 15 billion euros per month. On December 31st, that goes away. January the 1st, 2019, the European Central Bank will stop expanding the size of its balance sheet, and globally, we will, for the first time, once again, go net negative on liquidity. And the implications have already been, they've already been gleaned by the markets, right? Deutsche Bank has already observed that 89% of asset classes worldwide they're sporting negative returns for 2018. You can't make this stuff up. So the world has already figured out what negative liquidity feels like, what the drought could feel like. US equity investors, maybe not so much. We've had something else going on here in this country this year called share buybacks. So what differentiates the United States from the ROW, from the rest of the world? Why has it been so awesome to be a US stock investor in 2018? Well, I'm afraid I'm going to be a broken record here because it is one word, and boy, does this it just gets people so mad because they want to talk about fundamentals and earnings and in a monopoly society, mind you. We have just a few great big companies that are making everything and collecting all the profits, I digress. But what makes the United States the place to be, the it girl for investors? It's liquidity. Liquidity is global. Liquidity is fungible. Liquidity is agnostic. But liquidity also has a home, or had a home, here in the United States in 2018. The tax bill that was rolled out, according to JP Morgan, brought an additional $300 billion in share buyback power into the equity markets. That's on top of last year's $550 billion or so. So estimates suggest that we'll get to the $850 billion mark by the end of this year. Maybe GE's buybacks don't have the same bang that they once did. Maybe Apple's don't either. That might be heresy. But the fact is, we had something the rest of the world didn't, and we benefited greatly from it because the mother's milk of markets was still flowing through the United States in 2018, unlike our international counterparts. So that's what made this one heck of a year. So here we sit at the precipice of what we believe to be the next rate hike at the Fed's December meeting. We're looking to go to 2.25% on the Fed funds rate. Woo! But we know from what Jay Powell has told us that that is still 3 rate hikes shy of what he considers to be neutral, a neutral Fed funds rate where it's the Goldilocks level, where the economy is not overheating or slowing down. He considers to be 3%. Unfortunately, his predecessor, Janet Yellen, is on record as having implemented the slowest, most prolonged, most painstakingly painful tightening in U.S. history under her leadership. In other words, Janet left Jay with a lot of work to be done, with not so much time as the economy was heading into, as we know, June 2019 will mark the longest expansion in U.S. history. It's really hard to tighten into an expansion that's lasted as long as it has, but that's exactly what Jay Powell inherited. It was interesting that most in the media, when Jay Powell's name was rolled out, said, he's a Yellen clone. This is it. We're in good shape. This guy's going to be our next best friend. He's the market's BFF. And what did Jay Powell say after his first day in office when the Dow was down by 4 digits? Let me think. He said nothing. And what did he say at the end of February as the risk parity trade unraveled in bloody fashion? I'll borrow from another Real Vision guest, Christopher Cole, Artemis Capital out of Austin, Texas, good friend. And the way he explains it is very simple. The world was basically betting, there was a crowded trade that was betting that volatility would never rear its ugly head approximately forever. So into this comes the beginning of the liquidity withdrawal, which the markets didn't like one bit. Into this steps somebody who's not a Yellen clone, who's going to tighten monetary policy, who's going to be tougher, who's not going to say a peep when markets get upset. So what we saw was the resurrection of the long dead volatility in the month of February. And this is typically how cycles end, by the way. It's just they've never been this protracted. We've never had a year on record like we had in 2017, when the VIX, the volatility index on the Standard & Poor's 500, when the VIX was south of 10 for 50 some odd days in 2017, wiping, any other year in history, there had been 1 or 2 or 3 days that the VIX was south of 10, and it was always a sign to run for the exits. But not in 2017, not when you have $2.12 trillion of quantitative easing flowing through the capital markets worldwide, which creates this great reflation trade when only one country's manufacturing sector was contracting, that was South Africa. The rest of the world was booming, floating on this sea of liquidity. Again, once that started to be extracted from the markets come February, once Jay Powell said a whole lot of nothing in reaction to the stock market's hissy fit, then people got really upset. You ended up having an exchange-traded fund shut down that was based on this short volatility trade. The stock market felt that the worst had come to pass. An exchange-traded fund, ironically enough, named XIV, the opposite of VIX, had to shut down. So was this the reserve breaking the buck money fund moment after Lehman fell? Could we all breathe a sigh of relief and walk away and say, boy, thank God February's only 28 months. Can we get back to the market going up again, please? And thank you. Well, companies got back to the business of buying back their shares. And the tax bill was passed. And you have this gigantic surge of fiscal stimulus and liquidity going into this economy. What could possibly go wrong? Well, not a whole heck of a lot. Not until the liquidity once again started to run dry. What happened on October the 1st? What two things happened on October the 1st? Actually, October the 5th. October the 1st, the ECB reduced its taper to $15 billion a month from 30. So one more whisk away of liquidity. On October the 5th, according to Goldman Sachs, 86% of companies in the S&P 500 were in buyout blackout. It was too close to earnings. It was this 2-week period around when companies report earnings that they typically are not in the market buying back their shares. So this double whammy of this liquidity being pulled out of the markets, lo and behold, set off, and I won't use that word storm, in the markets. There was a big sell-off. It was not related to being short volatility, however. There's something called the Smart Money Flows Index. And it basically gauges, you can look it up on your Bloomberg, SMFI Go. It basically gauges institutional investors who trade in the first 30 minutes and the last 30 minutes of trading every day. We all know that the last hour of trading in the stock market is the most important. Well, this index peaked in January. And after this unwind of this risk parity, short volatility trade happened, a lot of people came running back into the market, especially corporate America. The smart money stayed out. Smart money was at the lowest level since 1996 in October. It never came back. It never put its trust back into what it was looking at. And lo and behold, it was not the unwind of a trade in October. It was managers selling their biggest holdings. It was managers taking their profits. There are moments in every cycle. I remember in 1999, some sell-side strategist, analyst came out and said, price line's going to 1,000, baby. And these moments stick in your mind. And every day when you're turning on Bubble Vision and they've got a little countdown to $1 trillion for Apple or Amazon, that was kind of my moment. That was my Priceline.com moment in the current cycle. And sure enough, Amazon managed to trim $200 billion of market capitalization off in the space of a few days because it disappointed on its earnings. And what we saw in October was the beginning of the end, of the passive investing trend in this country. I'll share something on a personal investing level. When you spend nearly a decade inside the Federal Reserve, you get a little bit freaked out about how the sausage is made. You get a little bitter about basically monkeying with price discovery, unfettered price discovery. I was raised as a young whippersnapper on a trading floor up here in New York, and I learned about bid, ask, spread, price discovery. That was how the world was supposed to work. Don't fight the Fed is the antithesis of price discovery. Don't fight the Fed has turned into a passive investing revolution, this great renaissance where investors can pat themselves on the shoulder and they can say, wow, I'm paying 0.25%. Look at my low fees. Well, what October taught investors, passive investors, was that momentum that is awesome, I mean, great, momentum is wonderful when these huge market capitalization stocks are going up, the FANGs. But it works the same way in reverse. So at Quill, we ran a little analysis that showed that the S&P 500 was down 10%, and then these mega caps were down 12% in October. So I think the rude awakening that so many investors have, 45% of equity funds right now are in some passive strategy. So let's say almost half of US equity investors have a rude awakening because they're going to find out that you can actually lose more in capital than you save in fees. And they're not going to like it. They're not going to like it one bit. But that is what Don't Fight the Fed fostered. There was no reason to study a company's fundamentals as long as liquidity was flowing through the market. All you had to do was buy the market, whatever that market was. And it ended up feeding into a lot of the unintended consequences that we have. The fact that you have, the death of innovation in America. If you're a big company and you're doing well, you used to stick around for your own initial public offering. That's no longer the case. And it ties back to don't fight the Fed. If I've got $1 trillion market cap and I see any form of competition in front of me, what do? I just buy it and get bigger. Because you know what? I can bet the farm. I can use, just like Americans use their home equity to cash out during the housing boom years, corporations can use their stock equity right now. It's fat, it's happy, it's expensive. But they use that, they're borrowing against their net worth effectively, to buy any competition that gets in their way. And then we wonder why the people in the Beltway in Washington, D.C. are all at Twitter. Well, maybe somebody should have reined in the Fed and made them stop this lunacy a long time ago, before we had actual macroeconomic consequences that are going to take down the baby boomers, by the way. So where's the economy headed in 2019? So my good friend David Rosenberg, he was one of the few people to, along with me, get derided in 2005 for calling the housing bubble what it was. I learned something as we've become friends over the years, and that is that there is one critical sector that flags a slowing economy, and that is housing. Housing leads economies into recession. Housing leads economies into recovery. So the beauty of housing is it's unbroken. It leads economies into recoveries. It leads economies into recession. It's got a nice sidekick called autos, and it is another uber cyclical industry that also flags when we're getting to turning points, when we're getting to economic inflection points. And what we know is that the delta matters, the change matters. I get a kick out of a lot of the punditry that says, back in 1981 and I had a 16% mortgage, and I just get a kick out of them because I sit there at the television making a triangle sign going, it's the delta, you moron. It's the starting point that matters. It's the fact that mortgages were 3% and now they're over 5%. The tightening that the Fed has undertaken is starting to bite. Starting points matter, especially when it comes to housing, especially when it comes to anything cyclical. So if you start off with a 3% handle on the mortgage and you end up with this 200 basis point move that we've seen, and now we've got mortgage rates that are at 7-year highs and they're north of 5% for 30-year conforming mortgages, it makes a huge difference. Housing prices have been going up very fast. I need to use my verbs correctly. Housing prices had been going up. All of the increase in average monthly mortgage payments in 2017 was due to home price appreciation, homes becoming prohibitively expensive, intuitive enough. In 2018, it has been a pure mortgage rate story. If you can imagine, as low as mortgage rates are today, the average monthly mortgage payment has increased by 20% this year. That is enough to stop a housing market in its tracks. And that's exactly what it's done. The danger that I see, the real danger that I see, that the game changer that housing can be, is if we have sustained declines in stocks, if this takes the wind out of the baby boomer generation, if their IRAs and 401ks are depleted, and God knows what's going to happen to their bond holdings, which they should be watching much more closely. If this happens, there is a logical place that baby boomers are going to turn to look for liquidity. It's like the L word. I carry the liquidity banner everywhere I go. Baby boomers will look for liquidity. And if there's one message I'd like to convey, it's that hollowing out an entire generation of first-time home buyers, the millennials putting off setting up house and home for a decade, is going to have real, true ramifications for the boomers. They're going to look to sell their homes, and they're going to realize that there's a yawning gap, a vacuum underneath them. Because the first-time home buyer millennial who should have bought their first home 10 years ago and didn't, and waited 10 years, they're in their first home now. They're not doing what they were supposed to have done. They're not moving up to their middle home in the buying cycle of life. They're not moving up to that move up. And who is going to buy baby boomers' homes? It's the move up crowd that can afford to trade up to the McMansion, but they're not there. They're absent. So as badly as baby boomers are going to need the liquidity from that home equity that they have to fund their retirement, it's not going to be there. We're going to see more dramatic home price declines than anybody's anticipating because of this demographic divide. Thank you, Federal Reserve. I think investors have been engaging signposts in trying to figure out which direction the wind is blowing. I think investors have had their eye on the wrong target. They've been watching stock market volatility. They've had their eagle eye trained on the VIX index. I'm not watching the VIX index. I'm not. Because nothing becomes unglued. Or as Chris Cole explained to me, February was just a flirtation with the unwind of this massive risk parity trade. We don't find out what unhinged looks like until we see volatility in the bond market. That is where the go-go juice is. If you're not following the MOVE index, put it on your radar. MOVE. Get rid of the VIX, follow the MOVE. Because it's the credit markets where damage can truly be done. Going into the last crisis, we had $170 trillion of debt globally. Today, we have over $250 trillion of debt. A lot of it's toxic. I am watching more closely than anything. I've done more writing over the past year. I was in front of the Wall Street Journal. I was in front of Bloomberg, even though I write for Bloomberg. I was in front of everybody in writing about BBB rated investment grade bonds. You must put investment grade in quotes. That is what I'm following the most closely. General Electric, I will remind you, was a BBB rated company. Its bonds traded like junk. This is the sector that has grown to be a $3 billion monster. $3 billion. Think about that. Where's the parallel? Oh, I don't know. Subprime mortgages circa 2007 peaked out at $3.2 trillion. The BBB segment of the investment grade bond market is now $3 trillion. It is larger than every other investment grade rated bond combined. Morgan Stanley did a recent analysis. I've got to agree with it. They think that we will see a third of this $3 trillion downgraded. They call them fallen angels. And I think we will see angels falling from the firmament in this next downturn because credit rating agencies have actually done something remarkably similar to what they did during the last run-up, during the last credit boom. Their analysts, believe it or not, I mean, I hate to convey such shock, but their analysts have been strong-armed by management that's paid by the companies they rate to maintain their investment grade ratings, because if they're not maintained, then big institutions fiduciarily cannot hold these bonds. And so they have bent. And who will pay? That would be grandma and grandpa, because their local neighborhood broker has told them that it is an investment grade bond fund and you're going to be just fine. There is something worse. There is the leveraged loan market. And this came right out of the mouth of one of the high yield strategists at a credit rating firm a few years ago. Remember this the next time somebody tells you about the virtues of leveraged loans in a rising rate environment. Again, capital losses, capital losses. Leveraged loans are basically issued by companies that cannot access the junk bond market. They're junkier than junk. So what do? They go off to their friendly neighborhood investment banker and they syndicate a big junky loan. That market is bigger than the high yield bond market. That's another benchmark that we've seen in 2018. Follow leveraged loans, follow investment grade. There's a reason investment grade has been so much bloodier than high yield. It's with good reason. So if you don't have an account at Merrill Lynch, let's say, maybe you should get one. Open a money market fund. Get access to weekly fund flow reports, because they tend to be the first signal that you'll see is funds flowing in and out of any given asset class. And they're what I follow the most closely to see where investment grade, where any asset class for that matter, is headed. I think the most difficult question to answer in today's environment is, where do you put your money? How do you protect yourself? Again, this is a vestige of being a Fed insider for as long as I was. And what we learn in downturns is the hard lessons of correlations. And unfortunately, asset classes tend to move in tandem when price discovery has been eradicated, when central banks prolong the business cycle artificially. So there really are so few places to hide, but I may as well share where I'm hiding. I have a lot of money in cash. It pays a lot these days. It actually pays more than inflation, so that's technically a lot. And it's an option for the first time in my investing career. Cash is an option for the first time. And believe it or not, I own a lot of short-dated municipal bonds. I like to say that there's no such thing as a Brexit. We weren't able to get rid of Puerto Rico. It was against the Constitution. But by the same token, we have a lot of states, municipalities that will have, they've got growing mushroom clouds over them. Chicago, Illinois, New Jersey, California. We will have municipal bonds that go belly up, and we will have serious pension crises in the years to come. But that being said, there are a lot of well-run states and municipalities. So I have found myself a great manager who doesn't buy funds at all, individual bonds that you do your true due diligence on. It's one of the last standing asset classes where you can truly do your homework and find out if you're going to get paid back your principal. Capital losses. Preserve your money. So I'm in very few places. I own a gold fund, because if we've learned one thing from lower for longer and from overly intrusive central banks, it's that there is exactly one asset class on planet Earth that is negatively correlated to pretty much everything else when the peanut butter hits the fan, and that's gold. Am I a gold bug? Are we going back on the gold standard? No, we're not. It's not practical. But that being said, if you want to hedge your portfolio, it's a really good place to be. But if there's one irony I will leave you with, it's Janet Yellen. This is a woman who said that we'll never have another financial crisis in our lifetimes. She attributes this to the fact that the banking system in the United States is cleaner than it once was. Recapitalized, kumbaya, cue the birds and the butterflies. Just have them fly on screen. Can somebody tell her where the capital markets are? Can somebody tell her where the growth has happened? And once she appreciates that and the fact that under her leadership, the Fed prolonged an economic cycle beyond where it should have been and prevented companies from defaulting that should have defaulted. That her second statement that this is going to be a plain vanilla, shallow, not bad recession. It's just going to be another walk in the park, what we have coming up. Well, we've got to clean up the last cycle, which we never did clean up because QE prevented that. And we've got to do the next cycle that's even bigger. So will it be plain vanilla? Will it be short and shallow? I don't think so. But I am happy that Janet Yellen is on the record saying that we would have a kind recession and that we would never have another financial crisis.